On your screen, trading below 1250 at this point in time. Let's get in then. Mark Keenan, strategist, cross-commodity research at Société Générale Corporate and Investment Banking. He joins us from Hong Kong. Mark, hi, welcome. With the gold prices putting in the worst quarter in 4 decades, what's your sense on where the commodity will find support now?
Well, specifically looking at gold, we very much continue to see prices moving lower over the foreseeable future. We originally put out something early in April when gold was around $1,600, $1,700 an ounce, calling for it to hit $1,375 by the end of the year. And that level was reached extremely quickly following the news and the events in April surrounding Cyprus principally. And the target was reached very early. We've since revised our target down for the end of the year to an average of $1,200 an ounce in terms of our Q4 average.
Mark, the silver report card is even worse, with more than 30% down in the previous quarter. What's your reading on the price outlook for that metal?
Yes, silver is a very slightly more difficult market to read and very volatile market relative to gold. The interesting thing and the somewhat concerning thing about silver is if we compare the ETF outflows, the exchange traded fund physical outflows between gold and between silver, we've had an enormous liquidation in the gold ETF that has very much aided in the negative sentiment in propelling prices lower. If we look at silver, whilst prices have moved somewhat delayed fashion to gold, but nonetheless very much lower, we haven't seen an equivalent level of liquidation. In fact, ETF levels over this year are actually relatively stable. There's a very small decrease, whereas silver we've had whereas gold rather we've had around a 20% outflow. So we see silver in alignment with gold moving lower for the rest of the year. And we have a Q4 target, an average target there of $22. Next year, $20 for the average of the year, and every year thereafter taking $2 off that, down to 18, 16, and so on. But it is a very much more volatile market than gold, and what we're seeing is that some of the delay in the weakness in silver that followed gold's move down in April was really market participants in silver, possibly thinking that the gold situation was specific to gold, anticipating more of a bounce in gold from the physical demand. And whilst the physical buying in gold has provided an element of support, it hasn't catalyzed the rally that many people were thinking. And that caused silver to shunt down into its next sort of range, as it were. Silver also draws support from copper. It's mined together with copper very often, and it shares a lot of common industrial uses in the electronic sector. And copper has also been moving down quite spectacularly. So there's really very little for silver to claw onto. And when we see, the equivalent outflows in the ETF market developing and moving into silver, we can expect further weakness in silver as well.
1% down during the day today. But Mark, final question to you. How would you read the currency declines in Asia and the commodity producers impacting on those prices?
Well, that's a slightly more complicated question. It's really currency moves and the moves that we've seen across all asset classes at the moment, do have a significant effect on the investment community, on asset allocation models and so on, and they translate into volatility across the complex. We're going to see much more of this and much more of these currency moves, specifically driven by moves in the dollar as a function of comments principally out of the Fed in the United States by Bernanke on some sort of timetable as to when QE is going to end, and indeed the mechanism through which the ending of QE is actually going to happen and develop. So I don't think the market is overly focused on the Asian currency moves per se, but certainly movements in the dollar are having the usual impact in commodities of causing them to weaken, and that's particularly evident in the gold market and some of the industrial metals markets. But ultimately, most of this volatility and most of this currency movement is driven by, with respect to the dollar, is driven by QE headlines. As we move out of this volatile period, QE will only end because the economy, the global economy, the US economy looks sustainable, looks to be able to stand on its own 2 feet. And this is a strong and bullish sign, and this is a sign of economic growth, and that is the largest driver of commodity prices going forward.
It sure is, Mark. I appreciate you taking time out for us and giving us your strategies on all of those commodities. Let's also